How will the war in Iran affect you and your portfolio? Well, have you been to the gas pump lately? We're already seeing how the higher oil prices from the conflict in Iran is causing gas prices to go up. And well, as long as oil prices stay high, that's going to lead into higher costs for many of the goods we use in our everyday life. That's called inflation. And inflation isn't good for your pocketbook, and inflation's not good for the markets. We've already seen the markets down 2 to 4%. That's not a lot yet. But if oil prices stay high and the conflict continues, we could see that correction get even larger. In fact, once the market goes down 10%, it's officially called a correction. Now, look, corrections of 10% are actually a normal thing in each calendar year. Historically, there's a 10% correction in each calendar year. However, 40% of the time that a market has a 10% correction, it continues and continues to bear market territory. And bear market territory is down 20% and goes hand in hand with a recession. I mean, frankly, we're on the verge of a recession here in Canada already. So how do you protect your savings? How do you protect your portfolio against that kind of outcome, just in case it happens? First, trusted advice. Research shows conclusively that when you work with a trusted advisor, it results in better outcomes. We've helped many clients over our 30 years navigate some difficult times that might lie ahead. Perhaps we can help you. Perhaps we can help you work through the 3-point checklist I'm going to talk about. The 3 points to help protect your portfolio, protect your savings in case things start getting worse. Number 1, think about what your financial needs are over the next 2 or 3 years. You don't want to have to sell good quality investments like good stocks at a bad time to fund your regular lifestyle, to buy something you've got in mind in the next couple of years, to help your children with their education, to help somebody else. The number one mistake in investing is selling good quality assets at a bad time. And when does that happen? When times are bad. So do the planning so that you aren't going to fall into that trap. Number 2, have you reviewed your asset mix in the last 3 to 6 months? If you haven't, do it now. Your asset mix is the combination between stocks, low-risk investments, and cash. Because you might be surprised by how much your portfolio goes down if things really get tough. And when people get surprised, it often leads to mistakes, costly, long-term mistakes. So review your asset mix. We have a software that will do a stress test for you. It will give you an idea of how much your portfolio might go down on different market conditions, and then we can consider safer alternatives. Number 3, add structured notes, monthly pay structured notes, and alternative investments to your portfolios. Monthly pay structured notes and alternative investments provide a solid 5 to 7% tax-efficient return. To replace GICs, those rates are just too low now. And to protect the savings, to protect the profits you have in your portfolio. Look, there are a lot of things to worry about short-term right here. Lots of things to be concerned about. So, seek out trusted advice. Be proactive. Protect your savings.